Jacob Field here from Ripehouse Advisory. This is a really special piece of content that I've put together. A lot of hands on deck here to gather this research. What we're going to be looking at is exactly which markets we should be focusing our attention on across the whole of the country in June and the next few months from here. Okay, I'm going to be diving right into an LGA and even a street level, and then running through the due diligence checklist that we do to go from thousands of properties to dozens of properties, very quickly, and with a lot of, I guess, resilience in that due diligence process. So it is going to be an end-to-end video. Please stick around to the end and let's engage in the conversation around it. This is a May going into June 2023 capital growth analysis. Which markets can we target in June and, in the immediate future for the highest performance in terms of capital and then, very importantly, income growth? I think we need to look at both sides of that equation there. All right, so this is not an advertisement. I am going to go through this content very quickly, but I do need to use this information to provide context. So we take auditing and reviewing our results extremely seriously. We have a CPA here on staff. This is every single purchase we have made professionally since 2018. So 5 full years, many hundreds of millions of dollars worth of purchases. Each of these dark blue dots is a property purchase with a client, and this is the compounding annual growth rate since purchase. So this property here has had a compounding annual growth rate every year since purchase of 15%. This one here closer to 25%. All right, so you can see this trend line. There has been a little bit of volatility in the short term because we haven't yet had a year pass since some of these purchases. And we can see that even over this last year through 2022, the annual compounding growth rate for all purchases in 2022 was actually 16%. All right, so this is through a time of market contraction nationally. The algorithm and what we're able to do still perform very strongly. All of this content, what I'm going to be talking through, is general in nature. If you would like this to be applied to your circumstances, then we potentially need to have a one-to-one conversation. This content is designed to be general in nature. Okay? This is just once again reiterating that we need to take a very sophisticated approach to assessing and improving our capital growth performance. The 1 year average capital city growth rate was minus 5.1% in 2022. We generated 16.2% across many hundreds of millions of dollars worth of purchases. 3-year performance, 18.9%. So we had really strong results in 2021. 5-year performance, 17.7%. So that really does demonstrate that this has been working for a long time. Okay, many, many years of strong capital growth performance. Our public recommendations were first made in 2015. So closing in on a decade of being at the forefront of pioneers of predictive capital growth analysis and assets purchases. So that's really showing that. What do these properties look like? This is a very typical purchase. We purchased around 100 properties in Adelaide in 2019. Okay? It wasn't on everyone's lips. We were using our data and our research to get in there and have a field day. This property, very representative of the type of purchases to show you. Very broad demand, very strong bones, nothing sexy. This type of property is very similar to what we all grow up in Australia. Not much can go wrong with it. You have retirees, share houses, mum and dads with kids, all liking this type of property. Good, reliable construction in a very scarce, demand-driven, established area. Purchase price, $395, current appraised value, $626, capital growth, $231. We have generated 14.3% annual compounding growth over the last 4 years on this property. Nothing special about it. It's just getting the right property in the right location at the right time. Okay? Before I dive into the individual locations and take a deeper dive once again into the due diligence that we would do on a daily basis for the individual properties, if you want to engage further in conversation around the suburb markets and this research, jump over to our High Performance Property Investment Facebook group. Or if you would like to apply this research and these locations to your individual circumstances, book a 15-minute no-cost discovery call with a member of my team and we can take that through you personally. Now, I wanted to discuss what are the locations in Australia that potentially are worthy of our attention right now going into June in 2023. So I'm just going to bring this screen up here. Now this data is a snapshot made at the end of May, right? So we have our own internal research, our own data aggregation platform. We don't rely on third-party sources. We spend a tremendous amount of money and resources on owning that process. Once you own your own data, you know that data in context to other data. And you can make decisions with the relationships between those data points with clarity and conviction. You're not relying on third parties and you don't know how they've calculated data. You own that process, so you, I guess, generate stronger reliability in your performance. This snapshot was made at the end of May. This is an observation of what we were able to do in the month of May. In all the suburbs which we recommend, which I'll take you through in a moment, we generated 4.1% capital growth across properties where we purchased throughout that month. All suburbs in the country went backwards. Over the last quarter, this is live data. It's extracted from our search engine, from our internal platform. This is live suburbs and live properties. So it's not in a spreadsheet. This is derived directly from our data sets. 6.2% in the last quarter, and we did see before 16.2% in 2022. Now, what are the top emergent local government areas in the country at the moment? Sunshine Coast, Logan in Queensland, Gold Coast, Bundaberg, Moreton Bay, Ipswich, Charles Sturt down here in South Australia, Fraser Coast, Townsville, Wanneroo, and Blacktown in New South Wales. Right, so you will note potentially, not many WA. Potentially it's quite heated there at the moment. We're still able to acquire some strong assets over in WA, but potentially our focus is moving more towards Queensland heading into the second half of this year. Now, there are many suburbs in Sunshine Coast. Some of them are going backwards. Some of them are definitely not buys at the moment. The individual suburbs are something that we would disclose and talk about privately with our clients. But it does give you an indication. I guess a pattern that we're looking at here is the surrounding LGAs around Brisbane. South, north, and even Ipswich here, inland into the west, are all pushing forward, and Moreton Bay in the north as well. They are all pushing forward at the same time. Okay, really strong indications that the broader Brisbane market is just gearing up for another growth cycle. Now, when you look at this, Queensland, we have seen 122 suburbs emerge in the last month in Queensland, which are now satisfying our capital growth requirements. Our algorithm has evolved over the years and is now very strong in performance, but we have the lion's share moving towards Queensland. This is really interesting. Of all the suburbs in the country that meet our capital growth requirements, it is only the top 10 percentile of all locations. 1 in every 5 of those suburbs in Queensland is one of those locations. Okay, an extremely high concentration of our capital growth locations. You compare that to New South Wales, where we have less than 7% of all New South Wales suburbs are actually approved by us. Northern Territory, 2%. So you can see here really 1 in every 5 suburbs in Queensland is meeting our capital growth expectations. A really strong sign here. So hopefully that gives you an insight into the local government areas that we should be focusing our attention on heading into June. But we need to make sure that we get the suburb, the street and the property right. This is only one piece of the puzzle. Now let's take a dive into the actual properties that we were looking at in the month. So this is actually in the last week. So, time flies. We're already the 6th of June now. This was a weekly snapshot for the last 7 calendar days. So I'm going to now bring all of this together and talk through end-to-end the research that we've been doing this week in the last 7 days. And this is now once again a live snapshot. It takes about half an hour for this page to actually generate, so I won't hit refresh up there. This data is actually extracted from all of our staff actions, all of the checkboxes, the inputs that were made over the last week, and you'll see in a moment how much work is actually done every week. All this data is actually pulled out automatically, right? Because it needs to be live. It needs to be a heartbeat or a pulse of what's going on. So over 15,000 suburbs that are investable in the country. Our capital growth algorithm only looks at the top 10 percentile of locations. Now that is based on our Ripehouse R score. That R score is responsible for that performance going, as we saw, all the way back to 2018 and before that. These suburbs are the strongest capital growth performers in the country, and the R score is how we find those month in and month out. So it's just over 1,500 that are in the top 10 percentile. Of those, I personally go through every month and I either jump on the ground, boots on the ground, looking and walking the streets, talking to locals that I've talked to. If I've been to that location in the last few years, I don't need to go back there again. I talk to the locals that I know about what's been changing. But over the years, the last 20 years as a property investor myself, I've basically been everywhere in this country. There's only a few places I haven't been to Broome, haven't been to Alice Springs. Basically everywhere else I've sort of been. I am then rejecting the majority. So one in every 5, 1 in every 6, 1 in every 7 of these approved locations from a data perspective make it through my human checks. Okay, so the data is then being combined with the human touch. And right as of now, there are only 239 suburbs that are approved. Really importantly, that is a good number. If you have under 50 or under 100 suburbs approved, you've got a lot of eyeballs on those locations. We want to be picking the eyes out of 230 locations, and that is the power of what we're doing, as you'll see in a moment. Now, you can see here, where are these 239 suburbs? Lots of them in Queensland, lots of them in South Australia, lots of them, a few less in WA, and a few less again in New South Wales, then a few in Victoria, and Tasmania has 6. Okay, really we can see Queensland is, a third of these locations, more than a third. Now, this is the sweet spot. Right now in the country, the strongest capital growth profile is $495,000 and 5.2% gross yield. If you only have a $300,000 budget, we're not really giving up much. Okay, I would be expecting a 6% plus yield at $300,000, but we are definitely seeing very strong acquisitions at that price point right now. I saw before a $270,000 purchase. And once again, these 239 suburbs from May generated 4.1%. So these suburbs went up 4.1% in the month of May, in the last quarter. Not these suburbs, but the suburbs 3 months ago that were approved generated 6.2% since that 3-month period. Now, this is where it gets interesting, guys. We have a search engine that goes out every night looking at on and off market properties. It looks out over the web, brings it all together into the one place for our technology to do its thing. In the 239 suburbs that we're currently looking at, in the last week, there were 4,744 properties that were listed or discounted. So we're tracking discounting on every property in those suburbs. So these 4,744 properties were analysed by us. There's a huge amount of work. Now, of those, we applied first layer of preliminary due diligence. And we basically rejected 4 out of every 5 properties. And the numbers here, because of high supply on new construction, subjective, looking at where subdivisions and things are going in. This was a low demanded property configuration for the area. It might have been a 2-bedroom unit, not a 3-bedroom house. Or the incorrect bedroom or floor plan configuration, ineffective use of living areas, bad, laundries. This is also a subjective measure. Sub-optimum land size for area. Wasn't a square block. It might have been a triangular block. Land size might not have been consistent with what people are demanding. It might have been 300 square metres when people, larger families, wanting 500 plus square metres in that suburb area. Price, outside core demand, high public housing in the street. So we've rejected 4 out of every 5 properties. Then we apply our internal Ripehouse sweet spot analysis. These streets over a decade have demonstrated 21.9% higher relative capital growth to the remainder of the suburb overall. All right, so if the suburb goes up 10% for the year, expect these streets to go up over 12% in that same period. We get very fussy with the street level analysis, and once again, only around 1 in every 5 properties makes it through that far. Now, then we do our second layer of due diligence. We've gone from 236 down to 64. Of those, we rejected them now for a raft of reasons. Public housing, overlays, pools, configuration, once again, when we take a deeper dive. Main roads, overlays once again, railways, power lines, thoroughfares, conditions in the area of the property, subdivisions nearby, slope of land, auctions, schools, neighbouring commercial. The list goes on. So we've now come down to 64 and we started with 4,744. This is hours and hours or days and days worth of work with around a dozen full-time employees doing this all day, every day, okay, to get to this point. Of those 64 properties, that comes down to here now, 54 of them, we've now talked to 236 agents. We've done due diligence on the property. We've gone through and we've ticked all those boxes. We've rejected a huge amount of them. Now we do 64 formal appraisals of that property. It takes up to an hour per property. And then we've rejected a further 10 of them because the valuations are not stacking up with what we think we might be able to buy the properties for. So we've only got 54 live deals. 53 of them are assigned to clients because one of them potentially was outside of all of our client briefs, and then we made 20 offers in the last week. So that gives you a snapshot of the due diligence process and the resilience that you need to go to each and every week to find the standard of dwelling that generates the capital growth results that we have come to expect. And this has gone on now, as mentioned, for many years. Let's take a journey back in time. 2018, where were we purchasing? We were purchasing first into Adelaide, as we saw before, first into Bendigo in Victoria, and we were first into Northern Perth. Adam here purchased 2 properties, 2018, 2019. He's had 16% capital growth per annum on these 5 years, over the last 5 years. Just imagine, how would you like to have an investment property that's generated 16% capital growth every year for 5 years since you purchased it? Also, Harry purchased 2017, 2018, 2021 with us, 18.5% average compounding return across his 3 acquisitions. I'll go through these quickly, guys. You've been very patient. 2019, now we're moving into Brisbane inner north area, extensive acquisitions through Victoria, Queensland and South Australia. Once again, TAM, currently looking for IP number 4 with TAM, absolute legend. Devonport, Wagga, Perth, 19+% capital growth for his purchases. And then also Lance and Jess expats. So Tam's an engineer from Victoria. Lance and Jess expats. Lance is I think a pilot with Emirates. Excellent capital growth performance there as well. So I know he's a pilot based out of Dubai. I'm not sure if the airline, I think it is Emirates. First into Devonport, as we saw, Toowoomba. We bought 120 properties there in 12 months. Wagga Wagga. Everybody thought, why Wagga Wagga? Well, I know why, because the state government loves these regional centres when they start building hospitals and start upgrading medical infrastructure. Tracy, 3 purchases, commercial acquisition recently, 21% capital growth on average each year across these acquisitions. Chandra, absolute legend. Really proud of the work we've done alongside Chandra as well. That great capital Gold Coast property that I inspected actually myself when I was up there as well, has performed really nicely for Chandra over the years. 2021, first into Rockingham, back over into WA again. Toowoomba, continued purchasing through those areas. Once again, Imran, we're buying number 4 again for Imran. Actually, I think number 5 as well. And Tim as well, awesome capital growth. So this is just giving you a snapshot. 2022, go into it, Raj, onto 4 and 5. Parvez, we purchased 6 properties in 1 week for Parvez. He turned $2.4 million worth of his Sydney property into $2.4 million spread out across the country, saved $25,000 a year in land tax and generated an extra $100,000 a year in rental income. Took his 1 Sydney property for 2.4, bought 6 high growth capital property investments across the country, and is generating a net cash flow improvement of $125,000 a year. It really does go to show how we need to be smart and strategic in allocating capital. Look, hopefully that was useful for you guys for that May going into June capital growth snapshot. Just to take you through the types of locations we're looking at, the type of capital growth performance that we've become very good at generating into the future. All right, guys, if you like this conversation, you like this type of content, then it might be worth having a chat with us here at Ripehouse. There's a link below to book in a 15-minute no-obligation discovery call just to talk about what you're trying to achieve in property investment and to talk about if we would be a good fit to invest and to assist you alongside. Thank you.